This video is to help everyone understand the new Federal Loan Modification Program as presented on March 4, 2009. The objective is to help homeowners in mortgage trouble avoid losing their homes through foreclosure. The plan attempts to accomplish this goal through the use of modification or refinance. Since loan modification represents the bulk of this plan, this video will focus on that. The underlying concept of the plan is to encourage loan servicers to offer loan modification options to homeowners in distress. So that there will be no confusion about who is to receive what, let's take a moment to clarify three terms used throughout this video. A loan modification is any change made to the structure of the loan. This includes a change to the interest rate/payment. I say them that way because the two are tied together. It also includes any change to the term of the loan or the principal balance of the loan. It's important not to confuse loan modification with forbearance, which is nothing more than a temporary deferral of the past due amount, or a repayment plan in which the borrower agrees to make his normal payment plus something extra to make up for the missed payments. This video will also discuss the role of the investor and the servicer. The investor is the bank or other entity which owns the actual mortgage note. These are the people whose money you actually borrowed, or the people who bought the note from them. The servicer is the company who handles the administration of your loan. They collect the payments, mail statements, and hound you when you're late. The relationship between the investor and the servicer is that of employer and contractor. While it's within the power of the servicer to do certain things, the ultimate authority rests with the investor. While there are many types of servicers out there, for the sake of this discussion, there are only two types of investors: government and private. Government investors would include Fannie Mae, Freddie Mac, the VA, and other agencies. Private investors would include all commercial banks, S&Ls, investment funds, and foreign entities. At this time, just over 1/2 of all residential loans are now backed by the government. The rest are in private hands. The idea was simple. Give loan servicers an incentive to modify loans for borrowers who are either in trouble or likely to fall into trouble. For those loans that qualify, the goal is to reduce the monthly payment down to 31% of the borrower's gross monthly income. Keep in mind that gross is the amount before the deductions. The target payment of 31% is to include the principal and interest, taxes, insurance, and homeowners association dues, if any. To reach the 31% payment target, the servicer will reduce the interest rate until either the target is met or until the interest rate falls to 2%, which is the floor for this program. If the interest rate dips below the current market rate for the equivalent government loan, the loan may be subject to a gradual rate increase over the next 5 years or until the loan reaches market value as of the day the modification took place. At this moment, that rate would be about 5.25%. Should the interest rate reach 2% but the payment is still too high, the servicer may extend the term of the loan up to 40 years. If that doesn't work, it's up to the investor to decide whether or not they're willing to forgive enough of the principal balance for the program to work. When successful, the servicer will receive up to $1,500 from the government for modifying the loan and additional monthly payments from the US Treasury. The borrower is also rewarded for good performance. For every year the home is kept in good standing, the homeowner will receive up to $1,000 applied directly towards the principal balance for up to 5 years. Let's look at a couple examples of how all of this might work. Here we have a couple. She grosses $2,274 and he makes $1,926 a month before taxes. That gives us a total of $4,200 a month. Their current mortgage has an adjustable 8.2% interest rate based on a loan balance of $184,000. That would make the principal and interest payment on this home about $1,375. Let's assume that the taxes on this home work out to be about $140 a month and the insurance about $50 a month. According to the terms of the program, their current payment is $1,565. The goal would be to reduce that payment down to $1,302, which is equal to 31% of their combined income. Since the mortgage company has no control over taxes or insurance, the only thing they can do is lower the interest rate. In this example, if the servicer drops the interest rate from 8.2% to just under 6.1%, the total payment now equals the target of $1,302 or 31% of the borrower's income. Now, let's take a look at a more difficult case. Let's say our same two homeowners owed $284,000 instead of the $184,000. Because the house is worth more, the taxes and insurance would also be higher. Let's make the taxes $2,800 a year, which works out to be $234 a month, and the insurance $1,600 a year, which is about $133 a month. With these figures, even if you drop the interest rate to the floor of 2%, the payment is more than $100 over the target. In addition, this modification would be subject to the gradual rate increase over the next 5 years. Under these circumstances, the loan would be deemed unaffordable even after modification, and therefore rejected. This program applies to primary residents only. Your first mortgage balance may be no higher than $729,750 for a single unit dwelling and $934,200 for a duplex. The property cannot be investor owned or abandoned. If you own multiple properties, proof of residence may be required. Anyone wishing to participate in the program will need the following. You will need your most recent tax return, 2 most recent pay stubs, and a signed affidavit of hardship. Self-employed individuals may have other options to prove income. The servicer will require all parties to sign an IRS 4506T form. This gives the lender permission to verify your tax information directly with the government. The program is open to all loans closed before January 1st, 2009. When you apply, the servicer will evaluate your loan using an industry standard performance model. The model is applied for the loan as it is now compared to how it would perform after modification. If it is projected to perform better after modification, the servicer is more likely to approve the request. For all government-backed loans that are at least 60 days delinquent, the servicer is automatically required to run the analysis. In summary, this program should help up to 9 million homeowners. The good news is that for all servicers of government-backed loans, participation is mandatory. The process is designed to be fairly streamlined and is expected to become the industry standard. The bad news is that while the program is great for borrowers whose loans are in trouble, some borrowers who are current but struggling to keep up with their payments may not receive help. Also, participation by those servicers of non-government-backed loans is not mandatory. It is, however, expected that the vast majority of investors will participate to some degree. Well, folks, this was our short explanation of the new Federal Home Loan Modification Program. I hope that you found this video beneficial to you. As you can imagine, we're working hard to incorporate strategies for how to use this new program as a part of our Stop Foreclosure Like a Pro home seminar. If you'd like more information, please visit our website, www.wehateforeclosure.com. Good luck.